This is the Times Television Network, and you're watching ET Now.
Let's bring on board then our experts this evening. Societe Generale's Mark Keenan. Mark, your sense on crude prices. Are you bearish as well on the prices there? Do you see further declines? And if so, then to what extent?
Yes, it's an unusual situation on the surface of things with the level of geopolitical risk that we're seeing across the region. One would have expected crude oil prices to be higher than they are now, or indeed not to have seen the falls that we've seen. In short, the prices come off because very simply supply output hasn't actually been disrupted. With respect to Iraq, all of the production and the output from the country is generally concentrated in the south of the country, and in the north, where we have had US military strikes. The oil produced in that region, in the Kurdish region, is not entirely available to international markets, and the pipeline that was taking some of that crude out through into Turkey was destroyed earlier this year. So really we haven't seen anything any supply disruption to speak of, which is why prices have drifted lower. The recent move lower has been, over the last few days, has been driven by the latest IEA report, generally revising down their demand forecasts for crude very slightly for this year. And notwithstanding that, we've had inventories within Europe and Asia on the crude side pretty high, lackluster physical demand, and these have collectively been depressing the market from the supply-demand side of things.
Let's talk about the gold prices, and there's just about our holding 1300, not doing much. Mark, what's your sense? It's losing its luster as a safe haven bet for investors.
Yes, I think it's questionable as to whether it actually ever had it in the first place. There's perhaps a curious focus on gold right now. It's understandable considering how much gold fell last year. It was a significant move down. But of late, and certainly over the last 4 months or so, gold has actually been within an extremely tight range, less than $100 range. And if you go back and rewind and you look at the spectrum of geopolitical events and risks that we've had, from the Ukraine right through to the situation in Iraq, gold really hasn't responded at all. In fact, any meaningful rallies tend to be sold quite quickly. And in the context of the broader macroeconomic framework, that of rising rates in the US, that is very bearish for gold, and it's quite difficult to justify a long position or a fresh long position in gold with that framework in place. So we see gold lower for the rest of this year, not too much more, but down to around 1,250. I think we've been down to about 1,248 this year, so about another $60 from current levels.
Mark, would you see gold buying picking up in India as we head towards the festival season here?
Historically, that's always a very strong dynamic, and we do always see an element of that. Generally in the month of November, you get a very concentrated period of buying. So I do expect an upside bias to that, and I think that that will tend to overlap probably with much more clarity on the tapering and the guidelines from the Federal Reserve Chairman in the US, and that may sort of interlace with a much more crucial or a much more earlier potential rising rate profile that will provide, if anything, a selling opportunity from the Indian strength, with a view of prices trending lower thereafter.
Mark, also the base metal prices are still trading at a multi-month highs, even though we've seen some profit taking coming in today. What's your view on the sector?
Well, I think we have to be a little bit more granular within the sector. If we take the 5 main metals, we have slightly different profiles and dynamic for each of them. Copper's the main exception. We're pretty bearish on copper prices from here. for the rest of the year. We see that down to around 6,500 towards the end of the year, generally on rising mine production, and also copper being very vulnerable to risks in China, specifically risks surrounding collateralized loan structures that we've seen growing in greater magnitude of late, and any hint of regulatory tightening, a clampdown in the shadow banking sector, tends to manifest itself in a risk that some of these structures may unwind in some capacity, or at the very least reduce the demand for them going forward. So copper is vulnerable to that. The rest of the complex, some of the metals are very bullishly positioned in terms of their underlying supply and demand dynamics. Lead is one of them, zinc is one of them. Zinc has done quite a lot recently, so we may get a little bit of a pullback from the levels that we've reached. And then of course nickel, with the ban on Indonesian ore exports, going to remain in place in our view for some time going forward, and that will flip the market into a deficit for next year, and we see prices in nickel trending higher as the supply-demand deficit becomes more apparent going forward.
Fair point that, Mark. We will keep an eye on all of those fundamentals, and thank you so much for joining us with all of those commentaries on the commodities.
This is the Times Television Network, and you're watching ET Now.